this is Rick Savitsky from Chortek. In this video, I'm going to walk you through a tool we use with our customers to help them plan and make decisions. And specifically, I'm going to reference and talk about the new provisions in the One Big Beautiful Tax Bill and show how we can build a forecast and then show what if scenarios, assuming that we make a major piece of capital equipment expenditure and the impact on cash and taxes. So I'm going to be talking about tax concepts. This video is not tax advice, but if you'd like tax advice, give us a ring. Here are the assumptions we're going to use. I'm looking at a small, medium manufacturer, 78 million in annual revenues. They are profitable. There's expected taxable income, and it's an S corp. S corps don't pay tax directly. Shareholders do. The owners of the S corp do. So, but in this case, we're going to calculate the amount of taxes that would be owed if the corporation was paying tax, like a C corp, so that we can model, well, what needs to come out of the business, what needs to be distributed so that the tax can be paid. And that's really key in understanding what's the tax impact, and is there enough money, will there be enough money to make certain decisions. So with respect to decisions, we're going to assume, let's buy a $950,000 piece of equipment, a machine that we're going to use in our production facility. And we're going to incur some extra costs as well to get it up and running, some engineering, utilities, etc., so that we can also apply those and capitalize, depreciate, or write off those extra costs. So 1.1 million. And in this scenario, I'm going to assume we're going to use working capital, basically our bank account, to pay for these expenditures. I'm not going to model or show drawing on a line of credit or financing it. That may be very viable and wise to do. In this case, I'm going to show, well, just can we do it, and what's the impact of these three potential ways of looking at the depreciation. I'm going to walk you now through a really quick summary of the three methods. For book purposes, generally accepted accounting principles, GAAP, we need to have a methodology. It's up to us. We can decide as management what that methodology should be, but basically we're trying to match the life of the equipment over its lifespan and allocate that cost. Straight line's a real simple way. We don't have to use straight line. We don't have to use 7 years. We could just literally estimate how long is this expected to last, 10 years, 15, etc. That's the quick version. The other quick version is tax is very particular. The IRS in the US says this is how you're going to classify it. This is what its useful life is. This is how you're going to depreciate it. And there's some details of how that works. It's not straight line. It's a different methodology. There's a publication that you can look up that basically walks you through. There's tables of what to depreciate year 1, year 2, year 3 from a percentage. It's prescribed. It's very black and white. The big difference now with this One Big Beautiful Tax Bill is that there are incentives, very tangible incentives, to buy equipment because it can be written off essentially year 1. There are some limitations and phase outs, but nonetheless, that's the main black and white difference between these two. So what we're going to do is build a forecast, a baseline, assuming book depreciation, and then we're going to see, well, what if we do it tax, and what if we do it with the new bonus depreciation? That's what we're going to be doing in this tool called Fathom. But first, the bottom line. It's a big difference. $368,000, $100,000 based on that $1.1 million piece of equipment. Okay, that's the bottom line. This graph is showing, that's one of the outputs of our forecast. It's showing, well, just show me cash over time. So we're purposely kind of showing the gravity of using working capital here. We've got a little over 1.1 million in cash. We're going down almost to rock bottom based on that capital equipment. And then the bottom line there is basically showing either book or tax. It essentially looks like one line because there's almost no difference between the two. The big difference is if we use the bonus depreciation, and I'm purposely showing a little bit of a delay here, roughly a quarter later, the fact that what's that impact on cash? The main point here is we're able to retain the cash in the business to use for other purposes. It doesn't have to be distributed out to pay the tax. That's the big difference. So I'm going to switch and show interactively here just an overview of how we use this tool called Fathom. And I'm going to expand my screen in just a minute. One of the main things I'm going to point out, though, is that the baseline forecast is something that we collaborate on with our customer, and we make certain assumptions, and then we document them in the tool, and then we use it and roll it forward month after month automatically. As each month closes, it's always being refreshed. And so it's a combination of what do we think revenue is going to be, some assumptions on percentages, cost of goods sold, and then many of the other elements of the SG&A, we either say, hey, I think this is what we're going to be spending on marketing, for example, or let's look at the last 12, 24 months and do a regression analysis and have it roll forward based on past. So we can use a mix of both, and the end result is something that we can look at on a monthly basis, quarterly, annual, going up to 5 years into the future. Okay? In most cases with our clients, we're looking 6, 12, maybe 18 months out, but the point is we can go further and look at really big picture, which helps us with the next point here, modeling what if scenarios, what if we do this, what if we do that on top of it. And so that's what I'm going to do now. I'm going to switch here, make this larger, and show what's called a roadmap in Fathom. This gives us the ability to turn on or off certain possible activities. So 2 of them are highlighted on the screen here. What if we move forward with this Z100 machine on a book depreciation basis? And I'm also showing, well, what if we do a building expansion? I'm not going to talk about that in this video, but that's a major change in the new tax law as well. The ability to also take depreciation, essentially immediate deductions for building expansion used in production. Very substantial. But for right now, let's look at our simpler example. And if I click into it, I'm able to see the components that are going into this assumed activity. Really simple here. We're going to spend 1.1 million for the equipment. It's going to come out of cash. We also have some other non-capitalized expenses that I'm showing for the sake of illustration. There can be some other expenses that we're not going to capitalize. But the main point is we're going to impact cash. We're going to depreciate that equipment over time on a book basis. I'm using straight line, so the amount is literally the same every month. And then we're seeing, well, what's the impact on income tax and this accrual, this tax accrual based on the net in and out on the income statement. That's what's happening month by month. Key point here is we're not seeing the entire P&L. We're just seeing what needs to get impacted if we buy that piece of equipment. If there's some other detail that we want to show, we can easily add it as well so that anybody that needs to weigh in on the decision knows the assumptions behind this scenario. So with that said, key thing here is we're able to see the impact on cash for just what happens in this scenario itself, this little assumption. And then if I go back to my overall forecast, I'm able to see that rolled in now with everything else. I'm going to collapse some of this. Everything else in my forecast. Additionally, I can build different scenarios that have different assumptions for my what ifs. And by that I mean if I click on tax basis, the same forecast is recalculated, but it's taking, instead of the book depreciation, it's using the standard baseline book depreciation. So the only thing that's changing is the depreciation amount, the tax amount, and my cash. And there's not much of a difference really between book versus traditional tax depreciation. It's not identical, but it's not that much of a difference. In contrast, if I click the bonus depreciation, there's a massive difference. And specifically, the depreciation is huge because we're taking it immediately, and then the positive tax impact, the reduction of tax because of it, and then finally, the impact on cash is very substantial between book and versus this bonus depreciation. So again, just to show what we're looking at, I go back to the roadmap, I click on it, and it's the same basic assumptions. The difference here is that I'm taking, instead of straight line or over time, I'm taking the immediate deduction for depreciation all at once, which again is then going to calculate an immediate tax impact, reduction of tax. But because of the timing assumption, I told it, hey, delay that basically a quarter. And that's why when we look at our overall roadmap, I'm purposely delaying the impact of that for just a little bit, so we see it on the bottom line here with the impact on cash early in 2026. Additionally, we can take elements of what I was just sharing and include it in a report that we can securely share with others in the business owners, management, anyone that's going to weigh in on this decision. And the main idea here is that we don't have to only interact with the details on the forecast like I was doing a moment ago. Instead, we can take pieces of it and then share it, and then all be on the same page and work to a decision. Are we going to proceed? When should we proceed? Do we have enough cushion on cash? And so on. And so basically here we can pick and choose. I'm giving a summary of what those core assumptions were for this scenario A versus scenario B on the tax basis. And like I shared a slide or a screen grab before, here's a simple graph of cash and this divergence here of cash in the future just a little bit based on these three scenarios: book, standard tax versus bonus depreciation. And this final bit here is this major difference on our expected cash balance, assuming everything else again is the same. And there's other ways that we can just kind of visually show. This is just depicting the tax accrual and this massive difference between the two because of that one event, which is the planned purchase of the equipment. So that's how we use a tool like this. Again, it's refreshing itself automatically after each month closes. We're getting actuals most up to date. We can go in and tweak some of our baseline assumptions, and then we can also tweak our timing of possible, what if we do this, what if we do that? And again, to see this distinction here between scenario A, B, and C, and again, this really black and white difference based on the new incentives in the tax bill. So hopefully that gives you a taste of what we're up to, how we can interact, and we'd love to talk to you. If this video is helpful, give it a like, share it with someone else, please, that you think might benefit. But most importantly, reach out. We'd love to talk to you. Thanks a lot. Bye.